Hello, everyone. Just going to let me share my screen here. I'm Elizabeth, as most of you already know, but I just wanted to make this quick presentation for you just to explain to you about single premiums. So let's jump right in. First of all, single premium. Single premium is a whole life insurance policy. And I know that most people probably don't think that life insurance is an investment, but it is. It grows interest and cash value. So I'm focusing on just the single premium aspect of it because this is the one time payment that you don't have to make over and over and over every month. You make a one time payment. So this is just an example of how you can take this one payment and earn money for a lifetime. And just as we use the same dollar, we get to use the same dollar over and over and over again. It's a one time payment. That's why we call it single premium. So let's see how it works. So I'm going to use Mary for an example. She is a real estate investor. She's 45 years old. She's a non smoker. She's in good health. And she has money to invest. And she didn't want to lose a dime of it in the stock market. So she heard about the single premium whole life insurance policy and she wanted more information. So I shared with her the same thing that I'm going to share with you, that the single premium is a one-time insurance payment. And the minimum amount that you can make as a single premium is $25,000. So after our discussion, she decided to invest a minimum of $25,000. She deposited the $25,000 with our company, and it's still her money. Insurance company that offers single premium, not everyone does, but I have a few that does. So once she deposits this money into the insurance company's account, she instantly received a face value of over $47,000. And this was based on the cost of insurance at her age. As many of you know, the cost of insurance is based on your age and your health. So that her family will have enough to cover her final expenses and still she can still use the money. I continued to show her how she could use both the face value and the cash value. So as I was going over it with her, I showed her this graph. And based on her initial deposit of $25,000, that's the green line that you see there. This is her one-time payment. The blue line is her cash value that's available immediately. And you see how the line is curving up because it's constantly growing. And also you can see where her face value is the goal line here. So the face value, if she were to pass away, the growth would be added to her face value for her family, whatever growth that she had over her initial investment. She could borrow from herself immediately from her cash value, and the money she borrowed from herself, she could use for other investments. Maybe a down payment on a real estate project or something else. Who knows? It's her money. So she can do whatever she wants to do with it. In the meantime, her whole life policy is constantly growing. The original investment that she made is still there, still growing because she did not take it out. She borrowed against it. She never withdrew the money, she borrowed from it. So it's still in there and it's still growing, regardless of what she does with the money that she borrowed from herself. So the benefit of this money is that she can borrow it at any time and it's tax free. You don't pay taxes on borrowed money. It's her money. I don't know whether the money that she put in initially was already taxed or not, but the money that she borrows against herself is tax free. So the benefit of this money is that once she borrows it, it's tax free. And the face value, if there's a situation where she passes away and her family needs to use the money to cover her final expenses, that money also is tax free. So this is a tax free investment. So moving right along, let's talk some more about the benefits. She put in a single premium of $25,000. And as you see, all those zeros that are under the contract premium, she didn't make any other payments, not ever. Her cash value minus the cost of insurance, as you see, cash value is $22,000. And she can borrow up to 90% of that. So the more money you invest, the more you can borrow. $25,000 is just the minimum. And you can see where it all begins to grow over time. Now look under where it says death benefit. It stays the same under this guaranteed rate because it's a guaranteed rate built in that's going to grow your cash value regardless of how the market does. Guaranteed is going to give you amount that you see here. Now look at the non-guaranteed section of this page on here on the right-hand side. You see the non-guaranteed section here, and you see a significant increase in the net cash. It's because what they're based it on is the stock market is up and down. We know that. So then, as the stock market is going up and down, she is gaining annual income because they annualize it at the end of each year. Then they will calculate it up, the ups minus the downs, and give you that portion of the growths. So then the breakdown is to show you. Now, when they doing the ups and downs, you never worry about down. Down equals zero. Okay. And growth equals whatever that growth is, whatever that cap is. So you're always on the up and up. You're always winning. As you see, it is a steady, steady increase, a steady, steady flow. So here she can borrow up to 90% of the cash value, depending on what's in there. It will never decrease. So under the annual dividend, you see that here? This is the dividend, and it will increase the cash value. And this breakdown, of course, will also show you where, because they call it paid up premiums, it's going to be added to the death benefit. And if you look at this very last line, we originally said that your $25,000, as we see on the guaranteed side, bought you $47,970. But on the non-guaranteed side, based on the market doing well, we can go way over that amount. That very first year, we've gained over almost $1,000. Well, almost $1,000 here. That's 48,552, and that's just the very first year. So if you keep going all the way down that line after 10 years, you've gained over $10,000. And you still only put your $25,000 in there, but your death benefit is only it's over $62,000. Isn't that something? That's a great investment. You don't lose a dime, and you borrowed against yourself. Your money is still sitting there, and it's still growing on compound interest. It's still growing under compound interest. It increases your death benefit as well as your cash value. And why is that important? Let's see why this is important. It's an annual dividend. This pays dividends. Just like an IUL, the index is based on the index. It's not based on the stock market directly. It's not invested in the stock market, but it is based on the stock market. So let's go and show you how you can use this death benefit for your own advantage as well. Yes, the ones with the larger numbers in it. Let's see how you can use this to your advantage should something happen. So insurance is just in case something happens, right? So here we see that, like most people, as we get older, things in our body become out of control. We can't control what happens. We get hurt, we get old, things stop working, and we all got to have coverage for these things. This is called living benefits. Perhaps you couldn't work anymore, or you got a devastating diagnosis. You may need up to 90%, no, excuse me, up to, in this case, 80% of your money. These are riders at no extra cost in your policy. So this means if you come down with a chronic illness, a critical illness, or a critical injury, then you can get up to 80% of your death benefit as a living benefit. You take the money, you withdraw that money, and you do whatever you need to do with it. It is not borrowed money. It is actually withdrawn from your policy. It's not a cash value, but from the larger section or portion of this, it's your face value. It's paying you the most out of what you paid for because you paid for insurance. And as long as you leave enough in there to cover your final expenses, you will be fine. You can see that there's a max lump sum here. And you see in that line how much is still left for your family to cover your final expenses. That's if you choose to. And if you need to, take yourself on vacation, enjoy your last days if you got that kind of diagnosis from your doctor. This is the only policy. You can't go to the bank and try to borrow, let's say, $50,000 if you're not working, but you can withdraw $50,000 from your own account here. Say you only had the account 10 years. You can get $50,000. If you only had the account 1 year, you can get $37,000, but you only put in 25. That's a good investment. Now, for our last page here, we'll see that so far we looked at all of the benefits and we based this example or this illustration on a 45-year-old healthy female. But what if your one-time single premium payment, you wanted to put in 100,000 at one time, or 200,000, or perhaps even $300,000? You could still borrow up to 90% of that tax-free. In addition, your family would be protected by the face value amount that you leave in there. Also, you can borrow against it from your cash value up to 90%. This is an example of you becoming your own bank. This is an example of you having endless possibilities. Usually, if you have to go to the bank to get a loan or any place to get a loan, they make you jump through a lot of hoops. But in this case, it's your money. It's instantly sourced, instantly available because it's your policy. You only borrowed from your staff, but your original funds are still there. Your funds are sourced and they came from a legitimate place via your own policy. So if they ask you where the money came from one of your assets, this is an asset. We're so used to liabilities. This is an asset. We need to have this one in our pocket. There's no credit check, no score required. It's your money. So show me a better investment that you can put in $100,000 and instantly it's worth $192,000. Show me where that is, that your family can have that. You put in 100 and your family, if something happened to you that very first year, it's worth $192,000. Imagine the growth that this is going to have in 5, 10, 15 years. It's based on your age. This is for your family and it has instant living benefits that you can use for any type of disability, chronic or critical, that you may have. These were created for you. So now, this was just a sample or an illustration, but you can schedule your own personalized, no obligation plan today. I just want to say thank you for your time. Again, I'm Elizabeth Mosley, Queen of all trades. I do taxes, real estate, financial planning, and this is one of the financial plans and financial strategies that will save you a lot of money, protect your family, and give you the freedom to use your investment income at your own will, any way you want to, with a built in disability clause, disability rider at no extra cost. So if you have any questions, please don't hesitate to call me, text me. I prefer text 704-950, excuse me, 704-957-3087 from the Manone number. But you can also email me. But if you want to make sure I don't overlook your email, you definitely want to give me a text. All right. Thank you all so much. We appreciate you. And you have a blessed day. Bye bye.